And we now move on to insurance companies. This reading focuses on two types of insurance companies: property and casualty insurance companies, and then life and health. We can also have reinsurance companies, but this reading does not cover them. We'll spend a little bit of time on property and casualty first, and then we'll move on to life and health. With property and casualty insurance, we need to understand the difference between the two. Property insurance refers to protecting against loss or damage to property, whereas casualty insurance protects against legal liability. In either case, premiums are collected at the start of the insurance contract and invested during the float period. The float period is the period between collecting premiums and the time when money is spent on insurance claims. Now, if we have a prudent underwriting process, this will mean very few payouts, or the intent of prudent underwriting is to minimize insurance payouts. As part of the underwriting process, the insurance company should ensure that there is sufficient price for risks being taken. So if high risk events are being insured, then obviously the premiums need to be high. Also, there needs to be diversification. So if all insurance contracts are written against the same risk, then diversification is low. On the other hand, if we have insurance contracts against different kinds of risk, then that would indicate that we have diversification. Policies are typically annual, and the final cost is usually known within the year of the covered event. The claims tend to be unpredictable and lumpy. In terms of earning characteristics, there is a macro view and a micro view. If we take the property and casualty insurance industry, it's highly competitive, price sensitive, and cyclical. From a micro perspective, we should recognize that the underwriting cycle is driven by expenses. When the combined ratio is low, then we have new entrants. A low combined ratio means that the total insurance expense is low relative to net premiums. This means that the profitability is high. So high profitability leads to new entrants. When there are many new entrants, the industry becomes more competitive, and then companies leave the industry. So that's why we say that this industry is highly competitive, price sensitive, and cyclic. Given the fact that these contracts are typically for a year and the claims can be quite unpredictable, we just talked about the fact that the claims can be quite lumpy, which means that many claims can come in a short period of time. So this means that the investments need to be relatively safe. The investment returns should be steady. We need to take low risk, and our assets should be very liquid. And again, this is because we can have claims coming in at any point in time, so our investments need to be safe and liquid. The concentration of assets needs to be considered. So when making investments, we should avoid making investments in the same types of instruments. There should be a reasonable amount of diversification. The overall investment performance is basically the investment income that's generated divided by invested assets. As we've said, the assets need to be highly liquid. This is essential for the property and casualty insurance company. In terms of capitalization, there are no global minimum capital requirements. However, some local jurisdictions impose minimum capital requirements based on risks taken. So this illustrates a difference between the banking industry and the insurance industry. Banks often tend to be global. That's why we have global standards. Whereas with the insurance industry, the standards tend to be driven based on particular countries or jurisdictions. Now, this slide is extremely important. It highlights some of the most important ratios. The underwriting loss ratio, which is also called the loss expense and loss adjustment expense ratio, this is essentially our claims-related expense divided by net premiums earned. The loss expense is the claims paid, and the loss adjustment expense is the change in loss reserve. So simplistically, this is the amount of money that we spend meeting our claims. This is the total premiums earned. This ratio tells us how good we have been at estimating risks. If this ratio is low, that's a good sign. If this ratio is high, that means we've not done a good job of estimating risks. Underwriting expense ratio is our underwriting expense divided by net premiums. This indicates the efficiency of money spent in obtaining new premiums. These two ratios can be combined to give what's called the combined ratio. So it's simply the sum of these two ratios. It gives us a sense for the overall efficiency of an underwriting operation. Then we have dividends to policyholders ratio. This is also called the shareholders ratio. It is the dividends paid to policyholders or shareholders divided by net premiums earned. And finally, we have the combined ratio after dividends. So here we consider the combined ratio as well as the dividends paid to policyholders. From an exam perspective, I would say that these ratios are the most important. The underwriting loss ratio, the underwriting expense ratio, and the fact that these two add up to give us the combined ratio.